You are listening to The Investor Way with Sam Ball and Jonathan McEwen. If you enjoy the show, please subscribe and follow us on Twitter at TIWTweets.
Hello, welcome to the Investor Way with me, Sam Ball. It's the 10th of December 2024, and I'm joined today by my co-host John McEwen. And in this week's episode, we'll be discussing Halfords, Cranswick, Boohoo, Auction Technology Group, Pets at Home, and our US company of the week is PayPal. John, do you want to start us off with Halfords?
Yes, so it's the cycling and, well, increasingly now automotive centres. They had their half-year results out with half-year like-for-like revenue broadly flat at £864.8 million. Marginal growth in auto centres was offset by declines in retail as the cycling market remains challenging. Underlying operating profits fell by 4.3% to £26.4 million, with cost savings offset by an increase in the national living wage and a rise in shipping costs. Free cash flow improved from an outflow of £19.2 million to an inflow of £28.1 million. That was helped by reduced inventory levels. Net debt, including leases, improved from £372.3 million to £276.5 million. Halfords is comfortable with the current market expectations, which points to full-year operating profit of £41.4 million, and changes made in the recent UK budget are expected to increase its direct costs of labour by around £23 million. An interim dividend of 3p a share was announced, which was in line with the prior year, and the shares were up nearly 6.5% in early trading. In terms of valuation, Halfords has a market cap of £321 million and trades at 10.8 times forward earnings, which is broadly in line with its 10-year average, and it has a prospective dividend yield of 6%. I thought these results were okay. I think with how Halfords has been doing in the last few years, I wouldn't say it's a bit better, but I suppose it is, flatlining largely. As we've said before, and I still feel the same really with it, I'm not convinced by its retail operation. And I certainly think there's going to be pressure there. And they have said that the labour costs are going to be higher by 23 million. And then there's going on to the sort of the lower margin servicing. I appreciate it's not a market that's well consolidated, and that's what they've been trying to do. But I think with the popularity of PCP deals on cars, which often include servicing, and then the more complex cars get when it comes to the computing aspect, they seem to be locking them down more for main dealers, which is just reinforcing that too. And with, as we know, for example, how the European car market is struggling, you'd expect them to be even hotter on that sort of going forward. So yeah, I think it's very challenging for Halfords. And I suppose to a degree that's reflected in the valuation, but it's still definitely not one for me.
I would agree. I think they're pretty lackluster. The NI increases and whatever else that's adding to the staff costs. There's nothing they can do about that, unfortunately for them. But full year operating profits were only 41 million. And then you can say goodbye to 23 million of it. So their operating profit, if they don't change their prices, are getting slashed in half. That's not great. But I think as well, we've covered it before. Their strategy's been very, very acquisitive. And I don't think either of us have been convinced by that strategy in terms of the auto centres. But I just think, well, you look at these results for the core business, focus on that. I
Yeah.
don't, there's not a lot to get excited about here. They're just going out and buying growth, and that's fine. But I think there should be more focus on the organic growth. And there's only so far you can get with cost cutting, and they have actually been unlucky with that to a degree, where they've cut the costs and it's just been cancelled out by the minimum wage increase. But that is the reality of the situation. But yeah, pretty lackluster. I think at 10 times earnings, it's not a ludicrous valuation, but equally, I'm not sure I'd want to pay it for such a distinctly average business. That being said, it's not a terrible valuation, especially with that dividend yield.
Yeah, I suppose the question is how long is that sustainable? Shall we move on to a much higher quality business, Cranswick?
Yes, so Cranswick is it's the closest we probably get to a Christmas special. So
Yeah.
Cranswick, the meat and poultry supplier, have come out with their half-year results. These are the results for the 26 weeks to 28 September 2024. The revenue was up 6.1% to 1.329 billion. Adjusted group operating profit was up 16.5% to 99.6 million. Adjusted group operating margin was up 67 basis points to 7.5%. Adjusted earnings per share was up 17.7% to 132p a share, and the return on capital employed was up 234 basis points from 16.4 to 18.7%, which I think for this kind of business is excellent. Interim dividend per share was up 10.1% to 25p a share. On the statutory measures, the operating profit was up 3.5%, profit before tax up 3.8%, and the earnings per share up 3.8%. The revenue from the core UK food business was up by 6.4%, and that was underpinned by 7% volume growth. Poultry revenue was up 16.4%, with poultry now accounting for 19.5% of total group sales. And the pet food revenue was 71.1% higher, reflecting a successful ongoing rollout of the Pets at Home contract. They've said the adjusted operating margin of 7.5% reflects the strong contribution from growing pig farming operations, the excellent capacity utilisation, and tight cost control. And they've highlighted further investment in pig farming operations, driving 18% increase in pig production year on year. They've acquired a long-standing supplier of RSPCA assured outdoor bred pigs based in East Anglia. Total capital expenditure was 47 million. 25 million fit out of the Worsley hummus facility is ongoing, with the initial phase successfully commissioned. £62 million multi-phase expansion project at the Hull Pork primary processing site is progressing as planned, and £27 million expansion of the 2 added value Hull poultry sites are on track to start onboarding large new retail contract in Q4. 20 million has now been committed to drive further fresh poultry growth. And in terms of valuation, the business trades at an actual PE of 24, but if you go on the adjusted PE, it's 20.5. And the share price is actually up 27% in the last year and 58% in the last 2 years. I think these results are outstanding. I think that return on capital employed is excellent. And the fact they're still able to keep investing that into the business at such a high level of return, I think is absolutely fantastic. I think in terms of the valuation, it's definitely not cheap, but it's a very, very high quality business and definitely one that I do like a lot. We've probably been covering it for about a couple of years now, in which time it's gone up 58%. I think probably the time to have taken a proper look for me, it feels like it was, I don't want to get too anchored, but it feels like it was probably a couple of years ago. I think now I'm just not sure I'd be comfortable paying that valuation, but it's a very, very high quality business. So if I did own it, I certainly wouldn't be selling on these results. What about you, John?
No, I feel quite similar, and it's one of those ones that I think we'd never looked at the sector before. Then we came across and thought, gosh, that does look good. And I don't know why we didn't actually dig into it a bit more. Maybe it was that sort of opportunity cost, and you thought, well, how much can you make in that industry? But there you go. Bit anchored, but it's fantastic business. I mean, one question to put back to you: where do you see it going forward?
It's a tricky one. Well, I think at the moment they are still investing in the poultry in particular, it looks like. They've got the pet food, which I don't think it's going to be a driver of the business, but it's a nice little add-on. My understanding, and it is a very limited understanding, but as a consequence of Brexit, there has been a much higher push for British pork and beef.
Yeah,
As well, they do have stuff like Ramona's Kitchen, which is the hummus.
yeah,
And again,
yeah,
that's a
yeah.
small part of the business, but I think they're probably as well positioned as they can be for whatever direction the industry moves in. But even still, you'd rather eat homegrown poultry, for example, than imported because it's going to be fresher for one thing, and it's probably, it costs money to bring it over as well. So I think they're probably quite well positioned. I don't know what the long term trends will be, but they've got the Ramona's Kitchen and whatever else, and I think they're doing everything they can. And I think as well, they've done such a good job in the last couple of years, with Ramona's Kitchen, with the pet food, with the expansion in the whole facilities, for example, that I think whatever direction it goes in, I think it's one of those businesses where you can be like, well, I don't know exactly what's going to happen, but I trust management to do a good job.
Yeah. One question that comes to mind is, do you think that the changes with agricultural property relief will have any impact on Cranswick?
I was thinking that as I was saying it, and I didn't know.
Mm,
I don't know.
yeah.
Because I think it would only impact in the sense, if supply is restricted, I'd say within the next 5 years, because I think by the time, if in 5 years' time, and we don't know what will happen in 5 years' time or where we
Yeah.
will be, but if a new government was to come in, it's not inconceivable that the backlash to this has been so strong that a new government puts it in a manifesto that they're going to reverse
Yeah.
it. I know
Yeah.
you can't
Yeah.
rely on that, but I think it's rare you get a piece of legislation that is as violently opposed as this has been. So
Yeah.
really, it's like you've got potentially then a 5 year window. How many people are going to sell up in the next 5 years? I know you've got the ones that might pass away and be unable to pay their inheritance tax bill if they pass away after the rules have changed.
Yeah.
But I think it's a wait and see kind of thing because if it
Yeah.
gets repealed in 5 years, the impact's probably not be huge. If it stays in place for a generation,
Yeah.
the structure of farming in 20 years' time might be very different in that you don't
Yeah.
have those smaller farms anymore. You've just got larger farms. So I know I've
Yeah.
not really answered it, but I don't think we really can answer it at this point.
No, fair enough. More as just a talking point.
Yeah, I'm
Right.
sure they've definitely considered that over at
Yeah,
Cranswick as
well,
well, but I
absolutely.
don't know if they'll have a
Absolutely.
conclusion either.
No. Shall
Right.
we move on to Boohoo then?
Absolutely.
So it's one of, well, fast fashion. We've covered it many times on the show before. We did get it what we thought was a cheaper price or cheaper valuation after COVID. And it was really after that COVID boom, wasn't it? Because I think the share price had a big rally and then it was sort of pulling back down. And I think we bought it around the same time, paid maybe 17 and a half times earnings for it, something like that, which compared at the time with its historical average seemed quite cheap. And
I
I'll
think they
come
were
on,
reduced earnings as well, in
they
our
were,
defense.
yeah, fair
Although it's hard
enough.
to defend.
It's yeah. So anyway, that was just a bit of a preface to coming on to onto these results. So they have their half year results out to the 31st of August. The headline figure is 147.3 million pounds loss for the 6 months ending 31st of August. And that was significantly increased from the 36.6 million a year earlier. If we break it down a bit more, in terms of gross merchandise value, pre-returns GMV fell by 7.3% year on year to just under 1.2 billion pounds. Post-returns GMV declined 6.2% to 807 million pounds. And then coming on to the revenue, that was down 15% to 619.8 million, which was reflecting a challenging market and a shift towards the commission-based marketplace models, and also those competitors Shein and Temu. Adjusted EBITDA dropped 34% to 20.8 million with a reduced margin of 3.4%. Operating costs fell by 18% to 294.3 million due to the cost saving measures that they'd implemented, and net debt increased significantly to 143.1 million pounds, but a new 222 million pound of debt financing facility was secured. In terms of the brand's performance, Debenhams marketplace and beauty offerings achieved 170% GMV growth, and that was the main highlight, to be honest. Karen Millen delivered modest GMV growth of 2.3%, and that was transitioning to a digital-first model. And then some of their youth brands, Boohoo, Boohoo Man, and Pretty Little Thing, GMV declined by 15.9% due to weaker consumer demand. Again, you would expect that to be moving over to some of those Chinese competitors. Strategic initiatives, they did close the US distribution center to enhance profitability, which anticipated savings in the second half of the full year 25. And they're focusing on transitioning brands towards the marketplace model for improved capital efficiency. And in terms of the outlook, management anticipates stronger GMV and EBITDA performance in the second half of 2025, driven by marketplace growth, cost efficiencies, and their brand investments. And a further capital markets day is planned at the end of Q1 25, and it's going to reiterate some of their strategic growth opportunities. I think as a background to this, there is a tussle going on in the boardroom, and Fraser's group, which is largely directed by Mike Ashley, has been trying to essentially oust some members of the board, and this has been playing itself out in the media. I think that result as to whether he's managed to install himself is coming out later this month. Obviously, we don't have a position on that, but I think that's one of the interesting things. Potentially a distraction to the business, but whether you see it as someone who knows how to run a business driving it forward, I think the board have been arguing that there may be conflicts of interest in that he owns the competitor ASOS and Frasers, and what sort of deals might be done if Boohoo was to be broken up. So I think there are some of the concerns. Valuation wise, we don't have earnings. It's not something at the moment that's really worth looking at. I still own the shares. I suppose it's difficult to come to terms with the reality that it's probably time to sell. I certainly wouldn't be buying the shares now, and I know you've already sold yours, Sam. It's probably the biggest cold bath I've taken on any stock. When I do, and it's likely that I will come to sell these shares. Thinking about some of the positives, you might say that some of those brands are half decent, and it's encouraging to see what's happening at Debenhams, but there isn't a lot going for it. I think the change that we hadn't appreciated and anticipated was those Chinese companies coming in and absolutely dominating. And I remember when we were talking about the warehouse in the US, and the demand was outstripping supply, and you thought, well, this is a fantastic sign. And then that demand has now just basically disappeared. And that shift over has well and truly happened. I think it was also interesting to point out that neither of us actually used Boohoo, which and I think when we'd spoken to people, sort of our family didn't really use it either. So whether that was an early sign, sort of that Peter Lynch might have told you, the finger in the air sign that things weren't quite right and that we were catching that falling knife. But anyway, I don't think I have much more to add to it, to be honest. And I don't think there's a lot positive. It's very hotly debated whether Mike Ashley whether it would release value for shareholders, and if things were broken up. But I think it'll be a sad ending either way for Boohoo.
I don't have a huge amount more to add. In terms of the anecdotal evidence, my girlfriend does like to remind me whenever we bring it up. But she actually told me not to buy Boohoo because she said no one used it anymore.
Yeah.
It's far more insightful analysis than anything I did, that's for sure. But yeah, I've already sold. I think for me, what it was is I don't mind holding a business that's gone down a lot if the thesis is still intact. So, for example, with my Fiverr shares, they must be down 60%, 50% or something. And that's after quite a decent rally in the last few months. But I think with Boohoo, the issue was I just felt the market had changed, and I felt it was fundamentally, I viewed the business very differently to when we bought it in terms of, like you say, these Chinese competitors just weren't there. There were a lot of, they were still expanding their capacity whilst the sales were dropping, which we viewed as quite positive because
Yeah.
they had more insight than us, and they thought it was going to switch back. And there's not really. I didn't feel there was enough at the time to suggest that the drop off was anything more than COVID demand that had been pulled forward, and it was just
Yeah.
going to take a couple of years to stabilize. That hasn't happened, and it just looks like a fundamentally different business. And I think I just got it wrong. I just didn't anticipate the market changing in the way it has. Now, ironically, we'll sit there and or I'll sit there and for example, we've done a few pharmaceuticals in the last few weeks, and I've said, well, they're too difficult. I don't understand this. I don't understand that. I don't understand fashion.
Yeah.
I shouldn't have bought it. And what's more, my one previous fashion investment was Debenhams, which
Yeah.
ironically is now owned by Boohoo
Yeah,
after it
which was
went
bought
bust.
out of administration by Boohoo.
So you'd think I would have learned, but I didn't. So I've definitely learned now. Unfortunately, it was quite expensive and I had to learn the lesson twice. But yeah, it's just a fundamentally different business. Probably the most annoying thing for me is that the people who actually currently bought in at the equity raise are up 10%. That bugs me a bit. That's life. They didn't buy in at £1.20 a share, I guess. Fair enough. But
Yeah.
yeah, I don't, if I was still holding, I think Mike Ashley coming in and buying it is probably the best possible outcome at this stage because I don't think management really have a plan. And I think they took a gamble increasing capacity and it was categorically the wrong decision. I think at least Mike Ashley can come in and shake it up a bit. But I don't own Fraser's Group. and I don't want to. And I kind of view
Mm,
Boohoo as the same. For me, it's a fundamentally different proposition to when I bought it, which is why it was such an easy decision to sell it in the end. And I think I sold
yeah.
it about 30p a share. So
Yeah, and the other thing that's interesting is that Mike Ashley, if things play out, he may be buying Debenhams back from what he'd previously let go out of administration to Boohoo.
yeah, so but in terms of like the related party transactions and stuff, I wouldn't be massively concerned about that because I'd imagine there'd be valuers crawling all over it. And the reality is they'll probably be in a position where there's not really loads of people lining up to buy some of these brands. So I don't think they'll be able to afford to be picky anyway. But yeah, I think Mike Ashley's probably the only beacon of hope, really. But I mean, that's that's saying something, I guess. Shall
Yeah.
we move on to probably a better business?
Yes, so Auction Technology Group.
Yes, so we have covered Auction Technology Group before, but for those who aren't familiar, I will just go over the fact sheet from their website. And they are the operator of world-leading auction marketplaces and auction services, seamlessly enabling bidders from around the world to access a range of secondary goods which have been curated by just under 4,000 auctioneer experts across two major sections: industrial and commercial, and art and antiques. The group powers 8 online marketplaces and listing sites using its proprietary auction platform technology, hosting just under 86,000 live and timed auctions each year. Our virtuous cycle benefits from both auctioneers and bidders. More bidders participating in online auctions results in higher realized prices for the second-hand items, and in turn attracts more assets to be listed on our marketplace. So some of the brands they have include, for industrial and commercial, Proxybid, BidSpotter, iBidder, and for art and antiques, they have Live Auctioneers, The Sales Room, Lotissimo, and EstateSales.net. And their CEO is actually ex eBay, where he spent 10 years. And he was actually it doesn't say what, but he had a leadership role at PayPal apparently as well, which I think is probably quite a good sign because it's quite a similar business. So, Auction Technology Group have come out with their full year results, and these results are for the year ended 30 September 2024. Revenue was up 5% to 174.2 million, and that was only up 2% on an organic basis. And all these figures are in dollars, although it is listed on the FTSE. Adjusted EBITDA was up 2% to 80 million, and the adjusted EBITDA margin was down 1% to 46%. Operating profit was up 17% to 32.4 million, and the adjusted diluted earnings per share was down 3% to 38.6 cents. Basic earnings per share was up 17% to 19.7 cents. Adjusted net debt was up 26.5 million to 114 million, and cash generated from operations was up 1% to 71.6 million. They've said the revenue growth of 5% was driven by 12% art and antiques revenue and 1% industrial and commercial revenue. Revenue was up 2% on an organic basis, including marketplace organic revenue growth of 3% and a higher rate of organic marketplace growth in the second half at 4%. They've said the operating profit increase of 17% was driven by higher adjusted EBITDA, lower share-based payments charges, and lower exceptional costs year on year. Gross merchandise volume was 3.6 billion, down 11% at a headline total, but with significant improvement in momentum as the year progressed and stronger underlying trends. Gross merchandise volume was down 4% in the second half and positive in the first 8 weeks of the current financial year, driven by recovery in industrial and commercial. Take rate growth increased from 3.6 to 4.2% based on continued success extending value-added services, including shipping, payments, and auctioneer paid for digital marketing, with value-added services now representing 24% of group revenue. Trade for the first 8 weeks of the year has continued to show positive momentum from the second half of the 2024 year, and they remain confident in their ability to sustain growth through the delivery and its strategic initiatives. For the year, they expect revenue growth in the range of 4 to 6%, supported by continued growth of value-added services and positive gross merchandise volume growth, also reflecting uncertain end markets. And the adjusted EBITDA margin of 45 to 46% reflects operational leverage from revenue growth offset by ongoing investment in the business. So that was one of the things I'd wondered actually, is why is that adjusted EBITDA and operating profit margin so low in the 40%? Because it's a kind of business you'd have thought could have had Auto Trader and Rightmove margins in the 60s, 70s, or even 80%. That being said, I think this is a very attractive business. I like the idea of the platform. I think there's a good opportunity there in that I think a take rate of 4.2% seems quite low, actually. I think there's a lot of scope to get that up. That being said, I don't know if they would have the ability to get their margins at the level of, say, a Rightmove, because if they're dealing with shipping and stuff and they've got their own experts, I think there is going to be a higher staff cost in that they need a certain amount of experts and kind of auctioneers and stuff that I don't see it having Rightmove level margins. That being said, I can see the margins being a lot higher than 45% or whatever they are.
Mm.
In terms of the valuation, it currently trades at a P of 37, but the market cap's only 692 million. And again, if you think they can get the margins up and they can get, there's still scope for growth and they can get the take rate up, it might be quite cheap, but you are buying it based on what you think it could be. As well, probably worth mentioning for that, the gross merchandise value decreasing. That probably is more to do with sort of the auction market generally. It's probably just not as hot as it was a year or two ago. That was my interpretation of that because it seems like the business isn't doing anything that wrong and it's probably much more resilient than the auctioneers themselves are. So I really like this business, but I find it very difficult to value. And although I think there's a huge amount of potential there, and I think there are reasons why the results are as they are, and the operating profit growth of 17% is excellent, and a lot of the revenue growth will probably flow straight through to operating profit going forward. I don't think I'd be comfortable paying 37 times earnings for it. I suppose in terms of the cash generated by operations, that's only $71 million, and the market cap is, what did I say it was?
About 600
692
million.
million
Yeah.
pounds. So that probably puts it at something like 12 or 13 times cash generated from operations, which actually I don't think is terrible. And the fact that they are reinvesting it all into the business, you would expect that to lead to some growth at some point. So yeah, I really, really like this business, but I find it quite difficult to value. I guess if you were to go based on cash, it probably is a lot cheaper, but I think I probably want to check it on another 6 or 12 months, but it is definitely a business I'd be interested in. What about you, John?
Yeah, I think it looks, operationally like it's performing very, very well. It's got relatively small market cap, and you think there's a lot of scope for growth. I don't know whether there are any sort of similar businesses that are operating in the US like this. You'd expect there to be, and it's not an area of the market we've I don't think either of us have really researched, but that would be something that I would be interested in having a look at and potentially a bit wary if there were something that might come over and sort of unseat Auction Technology Group.
But I guess that's the same argument as if someone comes over and tries to unseat Rightmove, if they can get to a level where they're entrenched enough before it
Yeah,
happens.
but do you think that
Although I guess to your point, if the buyers are international, it's maybe less of an issue.
yeah, and I suppose these things are less consumer facing than Rightmove is.
Yeah, that's yeah. So how does it work then? You because you're going through the auctioneer's website, aren't you? Sotheby's is a bad example because they'll probably have their own
Yeah,
platform, but you're going to Sotheby's and they're just basically hosting it.
yeah, I think you can go on to, for example, the sale room and you can look like nationally at sales that are going on. But I think you can also, a lot of people will probably just go, if they're older, maybe go to their local sale room website, and then that happens to be this sort of the sale room software.
But then is that more of a long-term tailwind in terms of
Yeah,
as more and more people? So, for example, your parents' generation might still go to the local auction, and that even if they like something that's on an online auction, they
yeah,
don't realize they're using it. But then if you want a specific type of item, you're going straight to the sales room instead.
yeah. No, no, I take your point.
But it goes back to the point in terms of valuing it. I think there's a big opportunity, but I think there's a lot of unknowns with it.
Yeah, no, absolutely.
Um,
Okay,
what have we got next? Should we
pets
move
at
on
home.
to a much simpler business?
Yeah, no, absolutely. So, pets at home, it sells pets and it's recently moved and pet products and it's recently moved into veterinary services as well. They had their half year results out last week with first half revenue increasing by 1.6% on a like for like basis to £789.1 million. The retail business was flat, but the smaller vets division grew by 18.2%, benefiting from the growth in appointments, subscriptions, and transaction values. Underlying pre-tax profit was up 14.1% to £54.5 million. That was helped by strong trading in the vets division and stable operating costs. Free cash flow increased by 10 million to 33.1 million pounds, and net debt, including lease liabilities, was 373 million. Growth expectations for the remainder of the year have been lowered, with pre-tax profit expected to be up modestly over the full year. Previous guidance was for an increase of 9% to around 144 million. And Pets at Home have proposed a 4.4% increase in their interim dividend to 4.7 pence a share. And the shares were down nearly 9% in early trading. In terms of valuation, Pets at Home has a market cap of just over £1 billion and trades at 11.7 times forward earnings, compared with a 10-year average of 15.7, and has a prospective dividend yield of 5.1%. I thought these results, from what we've got used to from Pets at Home, were a bit disappointing. They had a huge boom during COVID, and they've, I suppose, been trying to diversify the business a little bit more, which I think looks like it's working well for them. Moving into the veterinary sector has worked very well. It's growing pretty rapidly. I suppose one of the concerns on that point is that there is a Competitions and Markets Authority investigation that's going on, which is talking about monopolistic practices within some of the big veterinary groups. And you are seeing fewer and fewer vets, independent veterinary surgeons, I should say. And I suppose Pets at Home is one of those companies that, is not at the heart of it, but is allegedly involved. So I think that is, a slight worry. Other things, I think, as we mentioned before, NI increase and minimum wage, that's certainly going to impact on the retail business. So that's a bit of a concern. But those things aside, compared with its historic valuation, it is lower. It seems like a very high quality business. And I don't think that we've probably reached peak Pets. So it's not one that I would be buying at the moment, but I think in retail you could do a lot worse.
I thought these results were okay. They're not as good as we've been used to, but well, you're not going to have that every single half forever. So I think considering it's not as good as we're used to, and the vets division is still up 18%, and the underlying pre-tax profit is up 14%, and although the revenue is not really increasing much, the revenue mix is increasing to the more profitable vet stuff. I appreciate there's potential problems with that, which you have already covered, but I actually think all in all, it's a pretty okay quarter. I don't think it's terrible. And at a forward P of 12 and a prospective yield of over 5%, for a business that's actually, I think, in the last few years, proven itself to be of a higher quality than we maybe initially thought, I actually think it's pretty reasonably valued. That being said, I'm not going to rush out to buy shares, but if someone were holding it, I think, they could make a pretty strong argument as to why they are.
Yeah, no, absolutely. Would you be buying shares?
I wouldn't. I think there's an opportunity cost issue. I know it's proven itself to be more Amazon proof than I maybe would have thought, but I still don't love the retail exposure. I don't really know anything about the vet side. It's an okay business, but it's not. I think the move to vets is smart and it makes sense, but then it's what do they do when they've got a vet in every single store?
Yeah,
What do they do at that point? Where do they go? Because they're already pretty saturated. I don't think there's any potential for them to go international or anything like that.
yeah,
So I just think it's more an opportunity cost issue. But if you told me that I had to have it in my portfolio for the next 5 years, whether I liked it or not, I wouldn't feel terrible about it. It is a good business, I think.
yeah. No, fair enough. Okay, on to our final company, and it's the US PayPal.
Yes, so these results are about a month old. However, I own PayPal and haven't covered it yet for these results, so I just wanted to go through them. So they came out with their Q3 results, and net revenues increased 6% to 7.8 billion, and all these figures will be in dollars, and that 6% was the currency neutral figure. Transaction margin dollars increased 8% to 3.7 billion. GAAP operating income increased 19% to 1.4 billion, and non-GAAP operating income increased 18% to 1.5 billion. GAAP operating margin increased to 17.7%, and the non-GAAP increased to 18.8%. GAAP earnings per share increased 6% to 99 cents, and non-GAAP increased 22% to $1.20. The total payment volume increased 9% to 422.6 billion. Payment transactions increased 6% to 6.6 billion. Payment transactions per active account on a trailing 12-month basis increased 9% to 61.4. Active accounts increased 0.9% to 432 million. On a sequential basis, active accounts increased 0.6% or by 2.6 million. Cash flow from operations was 1.6 billion and free cash flow was 1.4 billion. The cash equivalents and investments totaled 16.2 billion at 30 September. Debt totaled 12.4 billion, and they've returned 1.8 billion to stockholders by repurchasing approximately 28 million of shares of common stock. On a trailing 12-month basis, they've returned 5.4 billion to stockholders by repurchasing approximately 87 million shares of common stock. That's on a market cap of 88 billion, so that's about probably something like a 6% yield in terms of the repurchases. For the guidance for the next quarter, they're expecting low single-digit growth in revenue, and they're expecting earnings per share of $3.92 to $3.96 for the full year, which would represent high teens growth. In terms of valuation, the business trades at a P of 23. However, the free cash flow is probably much more useful for this business, and the price to free cash flow is still only 13, and that's despite the shares being up something like 30% in the last few months, I think. So they're 88, and they've been as low as 60 actually. So they're up about 50% actually in the last 12 months. As a shareholder, I'm very happy with these results. I think it's excellent. I think really I'd kind of bought it on a valuation basis in terms of, I think people were talking about it as if it was going to disappear and Google and Apple Pay were going to replace it. And it was trading so cheap, it was basically like a tobacco company at the time. I think you were able to get it at a price to free cash flow of something like 9 or 10, and it was repurchasing about 7% of the shares a year. Even having increased 50%, I think it's still very, very cheap. So I think I'm quite happy to continue to hold it. And that being said, with these results, they've had the new CEO come in. I think by all accounts, he seems to be doing a very good job. But, talking about as if long-term risks from Google and Apple Pay, and they are definitely risks, but the average account is actually transacting more on PayPal than they were a year ago, not less. So it's not even trending in the right direction. This isn't like a tobacco company where it's like, oh, well, it's going to drop 4% a year and they can maybe increase prices to offset it or you'll get the cash back. This is a business that's still growing and it's being treated as, well, I felt like at the time it was being treated as if it was already dead. So yeah, I'm very, very happy with these results. I think in terms of when I bought it, I think this is probably the best possible outcome I could have expected in terms of the results and also the reaction to them. John, what are your thoughts as someone who's got a bit less bias than me?
Yeah, I mean, I thought the results are definitely good. I think what you mentioned about Google and Apple Pay, that was my big fear. And even though the valuation, it was very lowly, that that sort of ended it there for me. What I'm interested in from your perspective is that now you've seen the recovery in the shares. What are you going to do? Are you going to take profits or would you like to hold this business longer term?
I don't think I'm going to sell yet because I still think it's very cheap. In terms of if you look at other similar kind of companies, I don't think it's as high quality as Visa or MasterCard.
Yeah.
But even if you compare it to sort of any similar size company or even, I still think the valuation is low. I think at a price of free cash flow of 13 for a business that's buying 6% of the shares a year and is still growing mid-single digits, you shouldn't buy a business and hold it just because you want the multiple to be revalued. But I think because the business is doing so well in the meantime, I'm quite happy to just see what happens with it. If it gets to a silly valuation, I would definitely sell it. Like, for example, if it was to go up to, it'd be a nice problem to have, but if it was to go up to, say, 30 times free cash flow, I don't see a scenario where I'd be looking at it at 30 times free cash flow and going, yeah, well, I think this can, I think this is a great long-term hold. But at 13, I don't think I really need to worry about it because I think although it's done really well, but from a very, very low valuation. And I still think it's really cheap. So, if someone told me they were buying it at 13 times free cash flow, even despite that, it's easy to get anchored to that old price, but I still think it's pretty cheap. So at the moment, it's quite an easy decision because I'm just quite happy to hold it at that valuation. At what point I'd have to think about it a bit more, I'm not sure, but I think it would probably be as it started to approach 20 times free cash flow.
Okay. Okay. Fair enough. So then, of the companies this week, what would be your top pick and what would come last?
So I think there's some very good companies this week. I think I'll exclude PayPal because I own it. So for me, it would be between Cranswick and Auction Technology Group. I really like Cranswick, but I think I'd probably go Auction Technology Group based on that market cap and the amount of cash it seems to be generating. And although I think it's quite pricey, I'd hope it could grow into the market cap. That being said, I will not be going out and buying it at this valuation. Least favorite is quite easy for me. It's actually probably, well, it's just Boohoo.
Yeah.
I think Halfords got away with one there. Normally it's
Yeah.
Halfords when we cover them, but Boohoo is definitely worse.
Yeah.
By you?
I would probably go with Cranswick. That would be my top pick. And then, yeah, it's it is probably Boohoo, which is a sign as a shareholder I probably need to get on and just sell it.
Is there anything that is stopping you buying Cranswick? Is it just a valuation at this point?
Yeah, I think so. I think so. And I think probably also that maybe I don't have enough conviction in it. And there are companies, because I largely invest in the index. So it has to be quite a special company for me to buy shares in. And I don't think it's quite there.
Okay. I think that's everything in that case.
Thank you again for listening, and we'll see you again next week.
See you next week.
Thank you for listening to The Investor Way. To get in touch, please follow us on Twitter at TIW This podcast is for entertainment purposes only and does not constitute financial advice. Neither Sam nor Jonathan are financial advisors. For investment advice, please consult professional advisors.